Hello folks, this is Danielle from Martlet Investments with our October 2014 Educational Economic Update. In this month's video, we'll be discussing a couple of economic events that occurred last month and give you some insight into what that means for you as an investor. Please stay tuned at the end of today's update for a required disclosure statement. October was a jittery month for financial markets, and though the U.S. economy continues to do quite well, despite slowing growth in Europe and Asia, most signs point to accelerating economic growth in the United States. So let's take a closer look at what happened last month. Investors got their first look at third quarter economic growth and found that gross domestic product grew at a whopping 3.5% for the 3-month period ending in September, which was beating economists' expectations by a wide margin. And though GDP growth decelerated from its 4.6% pace in the second quarter, it was the fourth quarter out of the last 5 that the economy has grown more than 3.5%. Let's keep in mind that this is only the first growth estimate and we'll definitely see revisions. Higher or lower, we can't really know until more reports come in. However, at least one major player felt good enough about the economic growth to make some major policy changes. The Federal Reserve announced the end of its groundbreaking quantitative easing programs, meaning that after October, the Fed will no longer purchase new bonds to support the economy. This means that the Fed feels good enough about the economy to take off the training wheels. They will, however, hang on to their $4.5 trillion in bonds for a while longer in case the economy still needs a little bit of help. Digging a little deeper into the news, analysts are reading a bit of a hawkish tone to the Fed's announcements, which means that there's a risk that interest rates will rise sooner rather than later. Because the Fed feels optimistic about the country's economic outlook, some analysts think the rate hikes might come as early as spring of 2015. Either way, we're confident that the Fed will look closely at all the data available before making any big decisions. Consumers are also feeling great about economic prospects. Consumer confidence surged in October to the highest level we've seen since October of 2007. Overall, Americans are feeling much better about their job prospects and their ability to qualify for better jobs and raises. This is great news for consumer spending and the economy going into this holiday shopping season. Third quarter earnings seasons kicked off in October, and now more than half of the S&P 500 companies have reported in. We have a pretty good idea of how companies did last quarter. Overall, earnings are quite decent, but reports indicate that U.S. companies continue to do basically well. For the 287 companies that we know about, total earnings are up 6.5% from the same period of last year. Even better, revenue is up 5.1% as compared to a 4-quarter average of 3.5%. This means that demand is coming back, and U.S. firms can hopefully look forward to a better revenue picture in the coming months. Looking ahead, investors will be looking carefully at earnings data and growth prospects for the rest of the year. Although third quarter earnings are looking decent, analysts are now looking forward at guidance about fourth quarter earnings. Though the domestic growth picture is looking rosy, many firms are worrying about how slow global growth will affect their sales. With the recent strength of the U.S. dollar against foreign currencies, it's possible that exports will fall as they become more expensive to foreign buyers. As always, we'll keep you informed. And that's it for this October's Educational Economic Update. Once again, this is Danielle with Martlet Investments signing off for the month of October 2014. If you have any questions about what you heard in this update or would like to discuss your personal financial situation, please give us a call at 877-768-1919. We'd be happy to talk to you. Thank you guys for tuning in.